$100. That's all you have to start investing. The question isn't whether that's enough, it's whether you're about to make a massive mistake. Today we are taking 3 stocks everyone's buzzing about and running them through the exact process that separates smart investors from broke ones. The market's been on an absolute tear. 2023 brought massive returns. 2024, even bigger. And here we are in 2025. The S&P is up 16% year to date after a rocky start. Your social media feeds are flooded with stock tips. Your coworker won't shut up about their portfolio, and suddenly everyone's a genius. But here's the uncomfortable truth. Most of that growth came from just a handful of mega-cap stocks. Meanwhile, the investing landscape is littered with people who chased headlines, bought at the wrong price, and learned expensive lessons. Today, we're doing something different. We found an article from Motley Fool claiming 3 stocks are no-brainer buys with just $100. Bold claim, but instead of blindly trusting it, we're going to teach you our process. The same one we use every single day to analyze any company, cut through the hype, and figure out what something is actually worth. We're covering Marvel Technology, DraftKings, and Uber. 3 very different companies, 3 very different stories. And by the end of this, you won't just know whether these stocks are buys, you'll know how to analyze the next one yourself. Let's get started. The market has been on an absolute tear over the past 3 years. And if you've been paying attention, you know exactly what I'm talking about. In 2023, we saw massive returns coming off a correction the year before. Then 2024 rolled around with even bigger gains as momentum continued to build. Now here we are in 2025, and despite a rocky start to the year, the S&P 500 has rebounded strongly and is sitting at a 16% gain year to date after bottoming out in early April. But here's what most people aren't telling you. The majority of that growth has been driven by just a handful of mega-cap headline stocks. While everyone's celebrating, certain quality growth names are still trading at reasonable prices despite strong business performance. This creates a unique opportunity for investors, even though starting with just $100, to find real value in a market that seems expensive on the surface. The key is knowing where to look and, more importantly, knowing how to analyze what you find so you don't fall into the trap of chasing overvalued companies just because they have momentum. One of the biggest mistakes new investors make is focusing entirely on the price per share of a stock, thinking that a lower number means a better deal or that they can't afford expensive shares. This couldn't be further from the truth. And it's critical you understand this concept before you invest a single dollar. The price of an individual share tells you absolutely nothing about whether a company is expensive or cheap. What matters is the market capitalization, which is the total value of all shares outstanding. Think about it this way. Berkshire Hathaway's Class A shares trade for hundreds of thousands of dollars per share. Yet the company is actually less expensive in terms of valuation than Tesla or Nvidia, which trade for just a couple $100 per share. When you look at market cap, you're asking the right question. If I bought every single share of this company, how much would I have to pay? That's the number that matters. A $10 stock with 10 billion shares outstanding is a $100 billion company, while a $500 stock with 100 million shares is only a $50 billion company. Never let the share price fool you into thinking something is a bargain or out of reach. Let's dive into Marvel Technology, trading at $87 per share with a market cap of $72.8 billion. This is a lesser-known AI chip company compared to giants like Nvidia or AMD, but they're doing important work with major clients like Microsoft and Amazon. What immediately catches my attention is their enterprise value of $77.6 billion, which means they have about $5 billion in net debt. Now, they generated $1.6 billion in free cash flow last year, so theoretically, they could pay off that debt in about 3 years, which is solid. But here's where things get interesting and a bit concerning. Their 10-year profit margin is just 3.73%. Their 5-year margin is basically break-even or negative, and then suddenly last year they posted a 31.75% profit margin. When you see a jump like that, you have to ask yourself, is this sustainable or is this temporary? This company has been publicly traded since 2000, and they've only had 1 year of exceptional profitability. Can you really bank on that continuing? Their revenue growth has been decent, 10% annually over the past decade, 22% over 5 years, and they haven't grown excessively through acquisitions, which I like. When I run this through the stock analyzer tool with reasonable assumptions for future growth and margins, I get a fair value around $56 per share. At the current price of $87, this doesn't scream obvious deal to me, and that's an important lesson right there. Moving on to DraftKings, we're looking at an $18 billion company that remains the market leader in online sports betting, despite regulatory concerns and rising competition. This is a fascinating business because the growth numbers are absolutely explosive. 67% annual revenue growth over 5 years, and 40% over 3 years. They generated $530 million in free cash flow last year, which is impressive considering their 5-year average was negative. But here's what concerns me. Their gross margin has been declining steadily. If you go back to 2017, they were operating at around 80% gross margins, and now they're down to about 40%. As that gross margin compresses, it puts pressure on overall profitability. The company is still losing money on a GAAP basis, but generating positive free cash flow, which tells me they're moving in the right direction. When you look at analyst estimates, they're projecting earnings to grow from 27 cents per share this year to 4 per share in 5 years. If you apply a 20 times earnings multiple to that $4, you get an $80 stock, which would represent more than doubling from the current $35 price. When I run my own analysis through the stock analyzer, I get a fair value around $64 per share, which suggests there could be upside here. But you have to be careful with growing companies like this because of share dilution, which we'll talk about more in a moment. Uber is perhaps the most interesting of the 3 companies we're analyzing today because it's become part of our everyday language. When people need a ride, they don't say, call a car service, they say, Uber it. That's brand power you can't buy. The company controls a massive 76% of the US ride-hailing market, and their engagement metrics are strengthening with monthly active users, up 17%, and trips and gross bookings up over 20%. This is what we call operating leverage. They're growing revenue faster than they're adding costs. The company is now a $174 billion business, generating $8.7 billion in free cash flow, though there's a significant discrepancy between their free cash flow and net income that would require deeper analysis. What really caught my attention is that Bill Ackman, one of the world's most respected super investors, announced a $2 billion position in Uber earlier this year, making it the largest holding in his portfolio. The company is also positioning itself strategically in the autonomous vehicle race through partnerships with Waymo, NVIDIA, and others. When I ran Uber through the stock analyzer with assumptions for revenue growth between 6% and 14% annually and profit margins between 18% and 26%, I got a fair value range with a midpoint around 160 per share compared to the current price of 80. That suggests potentially significant upside, but again, this requires more research and due diligence before making any investment decision. Now let's talk about the 8 Pillars framework, which is something we use to quickly assess a company's historical performance across key metrics like revenue growth, profit growth, cash flow generation, and more. When I ran all 3 of these companies through the 8 Pillars, every single one of them showed what most people would call ugly results. Lots of red X's and inconsistent performance. But here's the critical thing you need to understand. The 8 Pillars is a backward-looking framework. It tells you what happened in the past, not what will happen in the future. It's designed to tell a story about how a company got to where it is today, not to give you a definitive buy or sell signal. This is especially true for growth companies that may have been unprofitable for years while investing heavily in expansion and are only now starting to generate consistent profits and cash flow. The 8 Pillars helps you understand the journey and identify potential red flags, but you can't make investment decisions based on it alone. You need to combine that historical context with forward-looking analysis of the company's competitive position, market opportunity, and financial projections. That's why we use multiple tools and frameworks in our process, rather than relying on any single metric or indicator to tell us whether something is a good investment. When you're analyzing growth companies specifically, there's one critical factor that can completely destroy your returns even if the business performs well, and that's share dilution. Here's how it works. Imagine a company has 10 shares outstanding, and you own one of them, so you own 10% of the company. Now let's say the company needs to raise money to fund its growth, so it issues 10 more shares. There are now 20 shares outstanding, you still own just 1 share, and suddenly you only own 5% of the company instead of 10%. Even if the company doubles in value over the next 5 years, your share price might not move at all because your percentage ownership was cut in half. This is not the same thing as a stock split, where existing shares are divided, but your ownership percentage stays the same. This is actual dilution, where new shares are created and sold. Many fast-growing companies like DraftKings have to do this to raise capital for expansion, and it's something you absolutely must factor into your analysis. When there's significant unknown dilution potential, you need to demand a higher margin of safety and use more conservative assumptions in your valuation models. Look at the historical share count and see if it's been increasing, and pay attention to things like stock-based compensation and convertible debt that could lead to more shares being issued in the future. The most important lesson from today's analysis is not about any of these specific stocks. It's about the process. Most investors lose money because they're trying to pick the absolute next winner, chasing hot tips from headlines or social media, buying based on hype rather than numbers. That's the wrong approach entirely. What we do at Everything Money is use a systematic process with tools like the stock analyzer to ensure we're avoiding the big losers, because that's actually how you build wealth over time. Our fifth tenet of principle-driven investing is that a great story becomes a bad investment if you pay the wrong price. You can lose money on an excellent company simply by paying too much for it. Hope is not a plan. I used to buy stocks hoping they would go up, but hope doesn't protect you when the market turns. It doesn't help you sleep better at night, and it doesn't decrease your fear. You need a real strategy based on numbers, not emotions or hype. When you analyze a company, you need to understand what it's worth based on reasonable assumptions about future growth, profitability, and the multiple investors will pay for those earnings 10 years from now. Then you compare that intrinsic value to the current price and demand an appropriate margin of safety based on the level of uncertainty involved. This is how you make confident investment decisions that let you sleep at night. So where does that leave us with these three so-called no-brainer stocks? Well, Marvel looks potentially overvalued at current prices based on our analysis. DraftKings shows some promise, but comes with significant uncertainty around profitability and dilution risk. And Uber? That one actually looks interesting with meaningful upside potential, though it definitely deserves more research before you put your money to work. But here's what I want you to take away from this video. It's not about whether you should buy these three specific companies today. It's about learning the process so you can analyze any stock that crosses your path and make informed decisions based on numbers, not headlines. The tools we use today, the frameworks we walked through, the questions we asked, that's what separates investors who build wealth from those who chase hype and lose money. When someone tells you a stock is a no-brainer, your job isn't to believe them or dismiss them. Your job is to verify, run the numbers yourself, understand what you're buying and what price makes sense. Demand that margin of safety. Because at the end of the day, the only person responsible for your investment returns is you. If this process made sense and you want to start using these same tools to analyze stocks with confidence, click the link below to try our $7 7-day trial at Everything Money. You'll get access to the stock analyzer tool I used in this video, our full course library, live community discussions, and everything else you need to stop guessing and start investing with clarity. And if you want to go deeper and learn how I generate monthly income from stocks I already own using covered calls, click the video on your screen right now to watch our complete options course.